So I've done a few videos recently about Paul Merriman and small cap value, and today I'm looking at one of the most simplest portfolios I've seen to implement a small cap value tilt for the hands-off investor. So let's take a look. Basically, the 2 funds for life portfolio consists of the following: a target date retirement fund and a small cap value fund. What are target date funds? Target date funds are very common, and most people will be invested in one or something similar as a default in their workplace pension. It's about as hands-off as it gets. Choose your intended retirement age and let the professionals take care of the rest. This is the ultimate simple path to wealth. These funds offer a diversified global asset allocation in a single product, automatically rebalances that asset allocation for you, and gradually dials down the equity exposure and dials up the bonds as you age, lowering the risk exposure as you approach retirement. This is known as lifestyling or the glide path strategy. Lifestyling is a sound theory and makes a lot of sense, especially if someone doesn't have the time, knowledge or temperament to manage their own investments. Target date funds are generally a fund of funds, which means they hold a number of index funds within one fund, and as a result they are low cost and widely diversified. The one glaring issue with target date funds is that they are often quite conservative and hold a chunk of bonds, which over the long term, while slightly less volatile, will generally result in lower returns. Adding small cap value to boost returns. As you can see here, for a 10k per year contribution that is increased with inflation over 40 years, adding just a 10% allocation to US small cap value would have increased the end balance by a huge amount. So this brings us on to the 2 fund portfolio. Here are a number of potential options of tilting the portfolios, using a similar approach of dialing up the exposure to small cap value in the early years and then gradually easing off the gas a little as retirement closes in to prevent a huge drawdown right before someone pulls the plug at work. So for example, 2.5 times age minus 25 in percentage would be the allocation to the target date fund, and then the rest allocated to small cap value. It would look something like the following. A 25-year-old early in their careers would be 100% small cap value. A 50-year-old 62.5% in the target date fund and 37.5% in small cap value, and a 65-year-old just entering retirement would be 100% in a target date retirement fund, resulting in a much higher balance but a similar volatility as retirement closes in. Obviously, this is not going to suit everyone, but I think there are some key ideas here that I haven't really seen discussed much in the mainstream financial freedom space. The Merriman Financial Education Foundation has done a lot more research into this area, so if you are after more in-depth analysis, then head over to their website at paulmerriman.com to take a look. As with all model portfolios, there is no one size fits all, but after researching a lot into small cap value tilts and the Merriman Financial Education Foundation research, it's definitely worth looking into if a factor investing strategy is something you're interested in. And the 2 fund portfolio is one of the simplest approaches to implement this strategy that I've seen.